Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day of trading today. And in today's markets, guys, well, the bulls are officially on their 8th consecutive day of green on the SPY and on the QQQs. However, I'll remind you, we have not truly solved any of the underlying macro issues that the markets face right now. It's a very mixed market overall, where tech seems to be leading the charge, but we are getting from several other companies, especially consumer-facing ones, some bad earnings reports, refusals to give guidance, lowering guidance, and even some corporations going so far as to start laying off some employees in the face of all the global macro uncertainty that we talk about on a regular basis on the channel. So, in the face of possibly tomorrow is a very important day. We have the non-farm payrolls. Non-farm payrolls, if the jobs report comes in weak, I bet you understand what the markets can do. It might put an end to this very beautiful 8 days worth of green in a row. Couple that with the fact that Amazon and Apple just came out with somewhat disappointing earnings, and as well, the fact that we are in a big resistance area for the SPY and coming into the 200-day EMA as resistance. Is tomorrow going to be the first red day? Well, we're going to have to pay attention and just have a look as of tomorrow, but that is definitely what it is feeling like right now in the after hours of today's session. So in today's video, guys, no real major news components to report. That will be tomorrow with the non-farm payrolls. Today, we're going to be doing a few things together. Number one, we're going to be talking about earnings. We will be going over Amazon, Apple, AirBNB, and McDonald's. Now, special shout out to companies like Eli Lilly, which would have been interesting to cover. They were down 11% after their earnings. Special shout out as well to companies like Reddit, who are up 6.51% after their earnings, which showed a jump in advertising revenue. And additionally, a company that I would love to cover today, such as MasterCard, which was largely flat on the day, but reported somewhat similar earnings to Visa, which we did take a look into the other day. So I'll be covering Amazon, Apple, AirBNB, and McDonald's today. Tomorrow, I'll be going over some of the ones that I missed over the course of the week. We'll be probably covering MasterCard. We'll additionally be covering one that I didn't do on Tuesday, but was there, Booking Holdings, also SPGI, which was there on Tuesday, and Spotify. And if I have time, maybe I'll slide in something like a Reddit, but no guarantees. So after we're done our earnings session today, we're going to be taking a look at our major technical analysis rundown of our major market indexes, see if we do have a pullback starting tomorrow on a daily and weekly time frame basis. What are the levels that we need to pay attention to for the pullbacks? We'll be doing a major index review today and then wrap it all off with a big tech name review, because a lot of people were very excited today after those Meta and Microsoft earnings, and it really showed with the gap up open and everything in the market running substantially. But then Amazon and Apple kind of threw some cold water on that bullish sentiment, and both of their earnings moves came in roughly in line, or for Amazon, well under the actual expected move. So after that, guys, we'll be pretty much done. No portfolio review today. We'll be doing a full portfolio recap in tomorrow's video. So it should be a fun one today. And I know the video might be long because I do a lot of earnings. If you want to skip to a certain portion of the video, always remember that the timestamps are down below in the video description. Let's get right into it, shall we? So the SPY up 0.71% today, and the Qs up 1.31, was a bit of an awkward day because we held a very high range for a majority of the day before really selling off hard here into the last 15 minutes of trade. It was pretty much the opposite of what happened yesterday. Yesterday, some end of the day rebalancing in the last 15 minutes. And today, in the last 15 minutes, we got the opposite, a little bit of profit taking perhaps after the beautiful earnings from Meta and Microsoft lifted the market yesterday in the after hours. However, we will notice that several sectors on the day were very mixed. Healthcare, the biggest loser, because Eli Lilly is the biggest component of that sector overall. Take a look at the heat map right here. You'll see it was largely a tale of big tech and only big tech. This is when it gets a little bit worrisome, yeah? After 8 days worth of rally, you would like to see the market still being broad, but it just was not. Consumer defensives not reacting too well to those McDonald's earnings, which we're going to cover very soon. Financials also lagging a little bit behind. Healthcare, the biggest loser of the day. And the bottom half of the market, some of your more interest rate sensitive sectors, were also not performing too well. So it was largely big tech carrying the weight of the market on its back today. And when that's at the end of a 8-day rally, perhaps the end, right? It doesn't look so good in terms of market breadth, and you might just be due for a little bit of well-needed consolidation. Taking a look at your one-day relative performance, you can see that even better how mixed of a market it was. Technology and communication services. Communication services, guys, is just Google and Meta and a bunch of telecom companies, right? But anyways, you guys understand. Consumer cyclicals were to the upside, to the downside. Healthcare, materials, and consumer defenses, which still continue to be a bit weak. I'll remind you, the tech earnings were good. Semiconductor earnings were good. And bank earnings were good as well. But consumer defensive, the industry that is supposed to be the most recession-proof, they have had, for the most part, very poor earnings, whether it was from Pepsi, Coca-Cola, even some other brand names like UPS, names like Whirlpool, other consumer defensive names, so to speak, right? Just have not been performing too good. They have a lot of macro uncertainty. Procter & Gamble said so as well. I know we don't cover them often on the channel, but that sector is not looking too good. They are somewhat recession resilient, but I wouldn't say that it's a recession-proof sector. No sector is recession-proof, just some are more resilient than others. So before we get into more technical analysis, guys, let us dive into those juicy earnings. And we're going to start it off with arguably the biggest one of them all, and that is going to be Apple. So Apple coming down right now, 4.13% after their earnings. There was a lot of focus on Apple because they manufacture, or rather put together 90% of all Apple products in China. So obviously with the tariffs right now, all focus was going to be on repositioning of their supply chain. Let's have a look at the numbers, shall we? So 1.69% beat on EPS and a 0.86% beat on revenue. Not too bad of a quarter for Apple overall. They did surprise on a few key metrics, and we'll take a look at that just very shortly. Revenue 5% up on the year, very good. Services revenue up 12%, operating income up 6% year over year, and EPS up 8% year over year as well. They had good operating margins. So as of right now, Apple's fundamentals aren't being too affected, but that may not be the case in the future. They also announced $100 billion of buybacks. You can say they're cheating on this EPS number by buying back so many shares, but I mean, it's their cash. They can do what they want to it, right? But it'll be fun to see them deploy a bit more cash into innovation. Moving on to the article, Apple expects $900 million in tariff costs this quarter, and it's very difficult to predict beyond June. Now, not only Apple has been saying this, guys, this entire season of earnings has been one where companies have said the exact same thing. There's just too much macro uncertainty right now to either raise or maintain guidance for the remainder of the year with certainty, right? Moving on into the article, right? So revenue, as we saw, they did slightly miss. A very minor miss on revenue here. Actually, excuse me, my bad, guys. They beat on revenue. I don't know why this number is red. My bad. I wrongly color-coded myself. I will reiterate, they beat on revenue. They beat on a few elements they missed. We'll get into it, right? iPhone with a beat on this time. Wow, I'm going to have to reset here. No, miss, beat. All right. iPhone revenue, 46.85. Good. I was surprised to see the iPhone revenue there beat. Mac revenue also beat versus the expectation. iPads as well. Wearables, that is where your miss is slightly. That's 2 quarters in a row for wearables. Services revenue, an ever rare miss on the expectation for services, the most profitable division for Apple. I'll remind you, their net margins for this division is 74%. Gross margin came in right in line with the expectations at 47.1. What did Tim Cook have to say about this entire tariff situation? Cook provided Apple's first comments on the impact of tariffs on its business on an earnings call with analysts, saying the company saw limited impact in the March quarter because it was able to optimize its supply chain. You may remember Apple flying Boeing 747s full with Apple products towards different destinations such as Vietnam and especially India. India is going to be a larger player in terms of producing the goods that are sold towards the United States. Apple has retained a lot of its production towards other countries because other countries don't necessarily have tariffs on China, only the US, right? So Apple expects overall revenue to grow low to mid-single digits on an annual basis. And that's been the problem with Apple for the past 3-4 years. They're just not growing anymore, right? That is just not good enough revenue growth when you're talking about a company at this size, right? It's a more mature company, yes. It's been growing 5% per year for the last 2 years, and now they're guiding for possibly even lower, low to mid-single. It's like 3, 4, 5%, right? 5 is the top end of that. It's very difficult to predict beyond June because I'm not too sure what will happen with tariffs, said Tim Cook, the CEO. We will manage the company the way that we always have, with thoughtful and deliberate decisions, with a focus on investing for the long term and with dedication and to innovation and the possibilities it creates. So a nice little optimistic, statement there by Tim Cook. As we look ahead, we remain confident. So of course he's going to say that, because if he didn't, the stock would be down double right now. Tim Cook told CNBC that Apple is already sourcing about half of the iPhones for the US from India, and most of its other products for the US from Vietnam, where tariffs are lower than they are from China, but still in place on Vietnam, still no trade deal. Apple still makes the vast majority of its products for other countries in China. If you look at the US, over half of the US sales of iPhones come from India. If you look at the other products, Mac and iPad and AirPods and the watch, almost all of the country of origin is Vietnam. Cook said the iPhone uses a lot of chips made domestically and that Apple is buying 19 billion chips this year from the US. Apple said its board authorized up to $100 billion in share repurchases this quarter, which is good. It's about 3% of their float right now. Tim Cook went on to say he hailed the double-digit services growth number, which had an annual increase of 11.65, although it did miss the headline expectation number. Mac sales were up 7%. iPad sales were up 15%. Those are very good numbers. The wearables division was down 5%. Sales in Greater China. We know China's been a pain point for Apple. Are they growing? Are they losing? Let's have a look. Which includes Taiwan and Hong Kong, were down slightly year over year at 16 billion. Cook said that China's sales were accelerating on a quarterly basis and that Apple sales in the region would have been flat if not for foreign exchange rates. So what is it? Are they accelerating? Are they not accelerating? Bit of a cloudy environment for Apple in China. I wouldn't say they're doing fantastic though. Moving on further, we don't believe that there was a significant pull forward due to tariffs into the March quarter, Cook went on to say, and there's no obvious evidence of it right now. So there are the major headlines for Apple overall. Now, in terms of more numbers, let's break it down. Here are some numbers that I put together in terms of year-over-year comparisons. You'll see total revenues here if you take the trailing 12 months from Q1 to Q1. Here's the Apple iPhones in blue. Do you see a problem with this? It hasn't been growing, guys, in literally 3 years at this point. What has been growing, though, small, is the Mac revenues. As you can see, this orange box, Mac revenues have grown more significantly in 2025 than they have been in the past year overall. iPad revenues as well have now been back on the uptick, but they were in 2023. Wearables are also underwhelmingly underperforming, guys, right, at this point in time. So 2023 was the high point, and now we've just been steadily coming down a little bit. But the bright point for the company definitely remains services, that column in the red. As you can see, services continue powering on to the upside. And this is the brightest point for Apple overall because it is the highest margin division for the company. And that's pretty much it for your Apple earnings. So Apple right now at 204, is the company a buy? Well, at the end of the day, guys, Apple is Apple, right? It's not going anywhere, but it is facing significant headwinds in the future. In terms of their balance sheet, you guys know this the best, right? They have a very solid balance sheet, tons and tons and tons of free cash flow on a yearly basis. They do have a lot of debt, but they pay it down every single year with their free cash flow, and they do have a significant amount of cash on the balance sheet. Their net margins for the quarter were about 25.9%, which is the annual average of the company. I would say it's no better or no worse than they usually do. And in terms of forecasts, here's where it gets a little bit strange. Well, EPS is net on the rise as they protect their profit margins and keep doing these incredible buybacks. But revenue, right? Revenue for Apple has been largely flat now. Well, I mean, it has grown, but all things considered, it has been largely flat for the most part, or very small growth since 2022, and should not be accelerating much before 2026, 27, and 28, as Apple still waits for that big refresh cycle that people have been waiting for now for the past 2-3 years, as PC, and personal electronics sales have been very low in comparison to the boom that everybody saw in 2020 and 2021. So at 204 right now, in the after hours, somewhere down there, is Apple a buy right now? Well, let's have a look. At $204 right now, you're looking at a 28 forward price to earnings overall, guys. That is very expensive. I was a big fan of adding to Apple when they hit the actual tariff bottoms of $180, but at 204, you're back up to a 28 forward price to earnings and a 2.67 peg, which is very high for the company. When it was all the way down here, guys, you were trading roughly in around a 2.4 peg, which is more manageable, and a mid-20s price to earnings range, which was also more manageable. But right now, I would not say you're getting the best deal on Apple, and Apple does have a significant amount of headwinds in front of it in relation to those tariffs. So if I didn't have a position on Apple, would I be starting one for a long-term portfolio? Yeah, but it would probably be a very small one. Apple used to be a very large core position for me, but I've been selling out of the company over the past 1 to 2 years, as I do acknowledge that the revenue rate in terms of growth is not what it used to be. Is it time for a swing trade perhaps? No, but if they do revisit under the 200 mark in around this support range down there, I might be tempted in the mid 190 range, where it becomes a long-term portfolio add for me again, would possibly be down here. If we can find it, between 190 and 180, I think you're looking at a much better risk to reward profile for a long-term portfolio. And that is everything I had for Apple earnings. That was earnings number 2. Now let's get into another big one, which is going to be Amazon. So Amazon coming out with their earnings and only down 2.3% in the after hours. The expected move, I will remind you, was 6 to 7%. So definitely somewhat of an underwhelming showing for Amazon. Maybe some people might be disappointed, but you shouldn't be disappointed with their numbers because they were actually quite good. They beat on EPS by 16.38%, which is fantastic. And they had a nice little beat on revenue by 0.33%. But we know with their e-commerce business, which is absolutely massive, it is always a question of tariffs once again. So let's have a look in terms of Amazon. What is Amazon saying for those tariffs? Well, here's your headline numbers. Revenue up 9% year over year. Very strong. AWS revenue was up 17%, slightly underwhelming, but still very good. They remain the #1 cloud service provider on the entire planet with over a 30% market share. Operating income was doing well at 20% year over year. Operating margins, this has been the highlight, which I've discussed many times on the channel. Amazon is no longer trying to be a top-line revenue growth company at all costs. They're still growing top-line revenue very nicely, but they want to put more emphasis on shareholder returns, so net income margins and more free cash flow. And you can see that with their beautiful operating income expansion and even some very nice EPS expansion year over year as well. Let's get into the article. Amazon issues light guidance noting tariffs and trade policies as factors. Let's move into it, shall we? So Amazon Web Services, unfortunately coming under the street estimate, 29.3, which is a miss, which is partially why the company is down in the after hours, though still a very strong number, all things considered. I did show you, right? 17% year over year. That's still fantastic growth. Advertising was the bright point for the company. 13.92 billion for advertising, guys. This is a very, very, very strong number in terms of advertising overall. That was 19% to the upside during this current quarter, year over year. Take a look at their advertising here, guys. Here's Amazon against everybody else. This column to the left is going to be the one we focus on. 19% for Amazon, beating out everybody else's advertising divisions, especially in relation to the other very large advertising players. So that was the brightest point of the entire report, in my humble opinion. Let's move into it. Amazon said it expects second quarter operating income to be between 13 billion and 17.5. Unfortunately, that was below the 17.64% estimate, so they dropped the bottom end of the range. That's another reason why Amazon is down in the after hours right now. The company expects sales this quarter to be between 159 and 164, which is growth of 7 to 11%. Analysts were at 161. So this guidance right here is, technically speaking, a slight guidance beat if you were to take the midpoint overall. Amazon noted tariffs and trade policies and recessionary fears are among a range of factors that could make its guidance subject to change. Another consumer-facing company, guys, talking to you that the recession is a very real probability if these tariffs are to be maintained. Amazon faces significant exposure to Trump's tariffs, primarily through its retail unit. That is very obvious. Many sellers on Amazon's third-party marketplace, which accounts for more than half of the company's total sales, rely on the world's second largest economy to make or assemble their products, talking about China, of course. Some sellers have already raised prices and cut back on advertising spend as they confront higher import costs. On a call with investors, Andy Jassy, the CEO, said the diversity of Amazon's third-party seller base means that some merchants aren't going to pass all or any of those tariffs on to customers. Some of those merchants, right? Because we know, as Trump likes to say, who's going to eat the tariffs, right? Well, sometimes the merchants are going to eat the tariffs. Sometimes the other country is going to eat the tariffs. But sometimes nobody will want to eat them and the consumer will have to pay them, yeah? Depends on the person. He went on to say that Amazon could emerge from the uncertain tariff environment stronger than before, given its ability to offer low prices. Jassy pointed to the COVID pandemic as a period when shoppers flocked to the site and the company grew its market share. I 100% agree with this statement as well, guys. No company is immune to the impacts of a recession. However, on the other side of one, some companies could emerge better than others, and I think that will be the case for Amazon. So even if Amazon does drop in terms of its stock price, I really think it's going to be exactly like Andy Jassy said, reminiscent of the pandemic, and it will be a tremendous buying opportunity for the other side of that recession, right? As people will move to the Amazon platform to secure some goods for low prices. Jassy acknowledged that Trump's on-again, off-again tariffs have made it hard to predict what impact they'll have on Amazon's business. It's hard to tell what's going to happen with tariffs right now, he told investors. It's hard to tell where they're going to settle and when they're going to settle. Net income came in at 17.13% billion, which is very good, guys. That is fantastic net margins, 11% net margins. It seems as though not too long ago, Amazon was a company delivering what? Either negative or very subpar net margins. Now, for the last year roughly, their margins have been steadily increasing to the high mid-single digits. And now, for some of the first times ever in the last 2 quarters, they have double-digit net income margins, once again focusing on the company's plan to drive money to the bottom line. Very solid. Sales in Amazon's cloud division came in just below the consensus estimates, as we said. That was the 3rd consecutive quarter of revenue misses, talking about that 17% growth for AWS. And we already covered advertising was a bright spot. Sales in the unit rose 19%. So in terms of your sales metrics, the KPIs for different divisions, here is your online stores revenues. It's not all of them. It only encompasses a portion of them. But look at this very stable and nice growth over the last 3 years for online stores revenue. AWS revenue is the column in blue. That is steadily moving up and to the right. Subscription services is also moving steadily up and to the right. And advertising services revenue, one of the bright points for the company, is also moving steadily up and to the right on a year-over-year basis, taking Q1 to Q4 on a trailing 12-month standard, right? So moving into some of the last slides for Amazon here, we're not going to go through all of them, but some that I did want to bring your attention to is the operating income, nicely moving higher on a year-over-year basis, 20% to be exact. Operating income trailing 12 months, 51%. This is the total operating income that the company is building up. You can see a net increase there, once again, trying to drive shareholder returns. Net income amounts are up 64% year over year. That is your bottom line. And here is your trailing 12 months total. Fantastic expansion of net income. When Amazon wants to make money, they can make a lot of money, guys. $65 billion of profit when you take the trailing 12 months into consideration overall. Segment results, North America up 8% year over year. That was pretty good considering what America is going through right now in terms of the uncertainty. International also remains somewhat strong at 5% growth year over year in terms of total net sales. So that was very, very solid overall, guys. Free cash flow is down a little bit as Amazon as well is one of those companies that is investing heavily in CapEx for AI and data centers. And Andy Jassy was very bullish upon this front on the earnings call, which I did listen to, by the way. That's why some of these videos during earnings season are uploaded a little bit late because, I got to listen to the calls and wait for the earnings to come out. And then I put together the entire video, yeah? And no reduction in share count, but this is a thesis for Amazon in the next 2, 3, 4 years as they continue driving money to the bottom line and increasing these free cash flow numbers. Eventually, you will expect Amazon to be a buyback juggernaut as well, similar to some of its other Mag 7 peers. That's everything we had for Amazon. Is it a good buy right now at $185? Well, I've been fairly clear on this in the last few weeks as we've been in or around the tariff fear lows. It's a fantastic company to buy for a long-term portfolio. Arguably one of my favorite companies for the next 2, 3, 4, 5 years. Sure, they're improving profits. That's one thing, but take a look here. They have a lot of debt. Of course they do because of the business model that they run, but they're stacking the cash pile. This is the column on the right-hand side and significantly starting to build up that juicy free cash flow. And as I said, improved net margins now to a double-digit range. Their forecast for the future sees an increase in EPS by a landslide through the next 4 years worth of time. And revenue, guys, in 4 years, it's crazy to think Amazon will be making almost $1 trillion per year, which is absolutely nuts. So the forward prospects of the company look fantastic. I love this one. It's one of my favorite in the market right now. At $185 though, are we getting a good deal? Objectively speaking, we are. It's under a 30 forward price to earnings, which rarely ever happens for Amazon. This is actually one of the cheapest valuations it's been at in a very long time, believe it or not. It gives them a PEG ratio of 1.47 because they're growing EPS at 20% per year. And free cash flow yield is low, but Amazon's not known. You don't buy Amazon for the free cash flow yield. Not yet, at least. So right now, I do think the valuation is fair and manageable, and I would continue to DCA into this company all the way through the tariff fear lows if we revisit those at some point this year. 180 to 160 is a fantastic location to buy Amazon. That's literally where it was in 2021. And what has changed since 2021? A lot. Not only the net margins, but take a look. How much EPS were they making back then? What, $3? Now how much? $6. They've doubled their EPS. What has happened with revenue? 2025 this year, $700 billion. How much were they making in 2021? $470, right? So almost a 50% increase in revenue and a 2x in EPS. This company is much stronger than it was back then, and you're getting it for the same price. So keep all of those things in mind. That is everything we had for Amazon. Now, company number 3, we're going to be taking a look at AirBNB. So when choosing between Airbnb and Reddit overall, guys, I had a tough choice, right? But what I want to do for you guys for earnings is bring you the companies that are more in line with what we're experiencing right now in terms of overall macro. I didn't do MasterCard today because we just heard from Visa and those companies go kind of hand in hand, right? So I didn't do MasterCard today because I already gave you a Visa earlier on in the week. Reddit, of course, it's a barometer of consumer sentiment in some respects, but overall, all of its revenue is from advertising. And we already covered advertising juggernauts earlier this week in the names of Meta. And, we just covered a little bit in Amazon and some from Microsoft's division as well. So we have some advertising details, no slowdown just yet. So I figured I should bring you AirBNB, which is an insight into consumer travel because they have operations on over 200 companies. So we want to know, how is travel both domestically in the United States, because there's been some rumors of people canceling trips to the United States, but also is international travel still remaining strong? As we heard from Booking Holdings the other day, that earnings report, I'll bring it to you tomorrow morning. So let's have a look, shall we, in terms of Airbnb. Down 5% today in the after hours. Why? What happened? The company had phenomenal earnings last time and since then has kind of fallen off a cliff with the whole tariff situation. Now currently still 28% off of that high they had earlier on in February. Let's take a look at the numbers, shall we? 2.77% in terms of an EPS beat, which was good, and a 0.48% in revenue beat. So what was the problem? Well, there's a few problems with Airbnb. Let's get into it right now. So Airbnb, you can see revenue 6% year over year, a little bit soft, but earnings 42% drop year over year. Now, they did have some realized gains on some investments that they made, which gives you a kind of a fake EPS read for Q1 of 2024, but that's okay. Still, though, a lot lower than you would have expected for this company, all things considered. Now, the key takeaways here, nights and experiences were higher, which we'll take a look at. Gross booking value was also higher, but they didn't miss on operating income, stock-based comp, and marking down some investments this time as well led them to have a weaker than expected operating income and also a weaker than expected net income. Those are the primary reasons why the company is down right now in the after hours. Let's take a look at their earnings, right? So Airbnb issues disappointing revenue guidance for the second quarter, a third reason why they're down, all right? So for revenue increased 6%, we just saw that. Net income fell to 154 million prior to 264 last year. For the second quarter, they're forecasting 3.02 billion at the middle of the range. Analysts had forecast 3.04. So, I mean, you got to take this headline with a grain of salt, right? Disappointing revenue guidance. I mean, they're not missing by too much, right? 3.02 versus 3.04. It's not a crazy miss, but it is a miss, and it is somewhat disappointing. Moving on further, in the US, we've seen relatively softer results, which we believe has been largely driven by broader economic uncertainties. So there you have it, guys. One of the largest travel operators on the planet now is confirming that the rumors of people coming to the US less often has indeed been true, at least over the course of this most recent quarter. While the company said it experienced strong year-over-year growth in North America, despite broad macro uncertainty, it reported softness in travel from Canada to the US towards the end of the quarter. Most nights booked in the US stemmed from domestic travel. So there it is. Gross bookings value increased 7% year over year, which is in line with the estimates. Night and experiences booked rose 8% to 143.1 million. They missed ever so slightly. The expectation was 143.4. They came in at 143.1. But all of these tiny misses, guys, they add up, and it doesn't allow a company to really rally into the after hours, although most of their numbers were up year over year. Excluding North America, Airbnb said that nights and experiences grew 11% from a year ago. That is very good. International remains a lot stronger than it does in the US right now, although the US is one of their largest markets. Airbnb also teased new updates to its platform coming later this month that will go beyond accommodations. They have an investor day on May 11th or May 12th, whereby they'll be releasing a brand new product line to the Airbnb suite of products. Curious to see what that is going to be overall. Now, in terms of their gross bookings value, you can see that that has never been a problem for the company over the course of the last 10 years. They've been steadily rising, and this year was no different overall in terms of the conclusion of 2024, looking very good, other than, of course, the pandemic, right? But you can't blame them for that. In terms of their earnings slides, they also do a good job of putting together some nice slides for us. Free cash flow at 1.8 billion. That was relatively standard. 154 on net income was a little bit light, however, so that's one thing to keep in mind. In terms of where we are here, the explanation for the net income drop decreased in Q1 primarily due to higher stock-based compensation, largely driven by an increased headcount, write-downs of certain investments in privately held companies, and lower interest income, unfortunately. So that's the reason for your margin drop. Now, in terms of the other things that they have going for them, geographic performance. This is what we want to take a look at, guys, in terms of the trends, right? So they're in over 220 countries, but the majority of their business is in 5 countries. We'll have a look at that. In North America, we saw low single digits nights and experiences booked growth in Q1 2025 compared to Q1 2024. The average daily rate did increase 2%. So although the company is experiencing a little bit of a lull in North American performance, especially from international people coming in, domestic to domestic was strong, they are able to increase their prices every single year and people still pay. That is indeed pretty good. Now, in terms of EMEA, if you guys don't know what that is, that's Europe, Middle East, and Africa. We saw mid-single digits night and experiences booked growth in Q1 compared to Q1 of 2024, which is not too bad. The ADR there as well increased 2% versus the year prior. Latin America, we saw low 20s. This is their best market. Low 20s percentage year-over-year gains, nights and experiences booked growth in Q1. And Brazil was the highlight of the company in that market, 27% in Q1. Maybe because there's a lot more people going to Carnaval in the Q1 period for Brazil. I don't know, but you know, the timelines do match up. Asia Pacific, we saw mid-teens nights and experiences booked in Q1. So Asia and Latin America, the 2 best growing markets for the company right now. So nice to see that they're growing double digits in terms of that landscape overall. Quarterly revenue, you can see a slight deceleration here in quarterly revenue when measuring over the comps. Quarterly net income as well, we already explained that away, but not a very good bright point for the company overall. Quarterly free cash flow is the next one I wanted to show. Down from last quarter, but down from last year, but still better than Q1 2023. So free cash flow, a little bit light. I'd like to see them bump this up more, but you know, they justified the slight decline in free cash flow, of course, by the higher operating expenses and the lower net income margins overall. So that's fairly self-explanatory, all things considered. However, the company does continue to repurchase shares every single quarter and every single year. As you can see right here, their share count has come down quite a bit. Even though they do stock-based comp, they're able to repurchase more shares than they dilute from stock-based compensation overall. So not too bad. And we also have a 2.5 billion share repurchase agreement authorized this quarter, which is roughly 3.2% of the float. So all that being said, is American Express, is Airbnb a decent company to buy right now in around the $115 mark, which seems to be a highly contested area in the last 3 years for this company? Well, let's have a look at some of their fundamentals real quick, and then I'll give my opinions on it, yeah? So in terms of their net margins were somewhat underwhelming this quarter at 7%. That is very weak versus the company's history of 12 to 15%, but we kind of explained what happened there, and the company did as well. In terms of whether or not they're sitting on a lot of debt, no, they don't really have that much debt. Their balance sheet gets an A+ from me. Decent amount of free cash flow per year and rising year over year, and a decent amount of cash and cash equivalents on the balance sheet right now. The updated portion of that is around $11 billion from their most recent report. In terms of the upcoming forecast, well, we can see they're doing a good job of increasing EPS every single year for the next 4 years, which is good. You always want to see that, and increasing revenue over the next 4 years as well. So the future forecasts of the company do look very bright. They've definitely carved themselves away a nice position in terms of a very large travel operator. And now at this point, they're kind of a household brand for short-term vacation rentals. That being said, at 115, are they a buy? Are they cheap? Well, they're currently trading at a 26.7 forward price to earnings, which is not too bad. We've often seen this company trade above 30. This is at the lower end of the range that we've been able to see in roughly the past 2-3 years of trading, and trading only at a 1.41 peg, which is very good. The best point, though, is they're trading at a very nice free cash flow yield, 5.7%. That is what I love to see. So low valuation in terms of EPS comparisons and a low valuation in terms of the high free cash flow yield, that means it is a buy for me right now for a long-term portfolio. If it's a company that you like, I think we're getting a pretty good price. But if we have more macro uncertainty this week, you can see some more slides. Now, the last time I added to my own long-term portfolio was at the beginning of the month of April in the lower 100s, and I would not mind buying it again there. Is it a decent buy here? Yeah, at 115? Yes, but you have to plan for future DCAs, possibly lower. Just understand that it's not because the business won't be growing over the next 3-4 years. It may just be due to some short-term uncertainty catalyst, which would result in a buying opportunity for me on Airbnb from now all the way through 100 and possibly even lower. Fantastic area to buy Airbnb if it's a company that you do like. That is just my opinion, right? That is it for company number 3. Now we got to get into another one, guys. And this one is McDonald's. Now, McDonald's needs no introduction. Everybody knows McDonald's, right? But we want to know, how is McDonald's faring right now with the macro uncertainty? Are people pulling back on spending like we've heard from Chipotle, like we've heard from Pepsi, like we've heard from Coca-Cola, like we've heard from Procter & Gamble, and so many other stocks in this consumer defensive segment overall? Well, let's have a look, shall we? In terms of their quarterly earnings were actually fairly decent here at a beat on EPS by 0.39, but we have a 2.34% miss on revenue. McDonald's does not miss very often on revenue. They've had a few challenging quarters as of recently. We know that. We've been covering it on the channel for the last 2 years. And we know that consumer discretionary spending has been a pain point for the markets in the last 2 years, coming off those 2021 highs, zero interest rates, stimulus checks everywhere, then massive inflation. People are much more cautious at where they spend their dollars nowadays. You add in some tariff macro uncertainty and you end up with a headline like this. McDonald's reports the largest US same-store sales decline since 2020. That is not good, guys. I mean, Walmart has said this, right? We covered so many other earnings in the past 2 months. When all the consumer-facing stocks are saying the same thing, and they have tons of data, guys, we have to pay attention, right? You really have to pay attention to this one. I know this rally in the stock market the last 2 weeks has been fun, but there are real underlying problems right now with a lot of these companies. Let's have a look, shall we? So, same-store sales in the US. Only the US. International was good. US same-store sales fell for the second straight quarter. McDonald's US same-store sales shrank 3.6% as the chain faced bad weather and a more cautious consumer. Now, the street was expecting them to decline. The guidance was for a decline as well, but that guidance was for a decline of 1.7%. Usually McDonald's doesn't miss by that much. They'll miss by a little bit on their guidance, but never truly by that much. 2% off the guidance to the downside is not a very good look at all. In the US, overall, quick service restaurant industry traffic from the low-income consumer cohort was down nearly double digits versus the prior year quarter. Not very good. And last year was pretty easy comps because they were struggling last year as well with discretionary spending. Unlike a few months ago, QSR traffic, QSR is quick service restaurants, by the way, QSR traffic from middle-income consumers also fell nearly as much, a clear indication that the economic pressure on traffic has broadened from low income to now middle income. And we talk about this all the time. The premise of a consumer-driven recession, what is it? Sometimes it's a self-fulfilling prophecy. If the media and everybody around you says that a recession is coming 100%, well, people are just going to stop spending and businesses are going to stop investing as well and may even lay some people off. When people are nervous about losing their jobs and already tight in their spending because of the price increases we've seen over the last 2-3 years, well, they're just going to stop spending and they're just going to stop eating out, right? And this is what's happening. It started at the low end, which was all last year. Middle and higher end was okay. Now, even the middle end is saying, maybe I better taper back on those McDonald's visits, yeah? Compared with its industry peers, McDonald's has more low and middle income diners, said the executives. And even though high income consumers are still dining out, their spending is not enough to offset the shrinking traffic from other income cohorts, very normal cohorts. Across all of its markets, McDonald's same-store sales fell 1% during the quarter. Unfortunately, net income was at $1.87 billion. Now, that was fine in terms of net income, guys. Net income margins were 31.4%. McDonald's is a franchise model, right? They have very, very high net margins overall. And this is roughly average with their historical, their historical numbers, historical numbers, to say the least. Numbers and averages. Maybe I made up a new word. I'll just say that from now on. For its part, McDonald's has already said it plans to lean into value meals and buzzy menu items, which is a strategy that worked for them last year when they were trying to stimulate discretionary spending, right? A month into the second quarter, the strategy looks like it's working. New McCrispy chicken strips, sounds good, have been selling well even before the chain has begun advertising the menu item. McDonald's also plans to keep its $5 meal deal for the rest of 2025. This deal alone, guys, was a very bright point for them, being able to maintain high amounts of revenue throughout last year and reattract those customers. In most of our major markets, we're seeing a similar story in regards to the challenging industry environment and softening consumer sentiment. So these recession fears are pouring into everywhere now. Europe, Asia. That's not the only place that we've heard this from, guys. Many other large corporations have been saying the exact same thing. The company's International Development License Market Division reported same-store sales growth of 3.5%, narrowly beating the analyst estimates of 3.2%. That segment includes Japan, China, and Brazil. So international still remains strong, but is coming somewhat down over time when you compare with last year's comps. McDonald's on Thursday reiterated its full-year outlook, including plans to open 2,200 locations overall, guys. So, I mean, they're still growing, right? This brand is no stranger to recessionary environments. They've been through a few, yeah? They went through COVID. They went through tariff episode number 1 in 2018, if I can find it there. They went through the 2001 dot-com bubble. They went through the great financial crisis. They went through the 1980s, all the way since when did the IPO? 1968. They know how to manage stuff. They know how to protect their profit margins overall. They are recession resilient, but not recession proof. Some companies make it out better than others, but they're not recession proof overall. So right now, near or around the all-time highs, at $310 roughly, is McDonald's a good buy? Well, we have to take a look at the historical norms, yeah? They're currently trading at a 25.2 forward price to earnings. Where does that stand in terms of where they have been in most recent years? We can see that the top end of the range is usually in the high 20s, but the bottom of the range is in the low 20s to high teens. So right now, with a 25 forward price to earnings, I would not say the company is cheap, but I also would not call them expensive. They're trading at a 3.36 PEG, but I should just erase that. It's not the best metric for a company growing under 10% EPS year over year. They have no problem growing EPS. It's just, they're not a growth stock or a tech stock anymore, right? It's more value and defensive. Free cash flow yield of 2.91%, that is also a bit low. So with a price to earnings ratio, which is kind of in the midpoint, and a free cash flow yield, which is also in the midpoint, you'd like to see this around 3.5 for McDonald's, which, I mean, it does happen sometimes. On the channel last summer, a few times last year, I was saying like, McDonald's is a buy down here. It's coming into the 200 weekly EMA, which it never tests. And I still reiterate the same fact. I'm not a big fan of buying McDonald's up here, even though if I had any McDonald's shares for my long term, I definitely wouldn't be selling. But where would be a better point to add? For me personally, guys, 280 all the way down to roughly 250 is my favorite location to add to McDonald's overall. It's been holding up price better than most throughout this tariff turmoil because, as I said, right, it's a stock that kind of outperforms in the context of a recession. That does not mean it won't go down. It just means if the SPY and QQQ go down 25, 30, maybe McDonald's only goes down 10 to 15. And that is outperformance, although it would be in the red. So you do want to be getting the best possible deal on McDonald's. And for that reason, I'll be more patient and try to acquire some down here in the 280 to 260 range if you get tests of historical EMAs such as that. But right now, the company is still holding up share price fairly well. We will see how the year evolves for them. And that is everything I had, guys, for all of the earnings runsdowns. Hopefully you guys enjoyed those. Now let's get into some fun stuff, which is the charts. So the S&P 500 to start it off with, guys. Well, 8 days of rally worth in a row. I know you see some red candles right here, but that is a net gain in terms of positive change on those days. So keep that in mind. 8 days in a row, bouncing out of the 200-day EMA, which is right above here, 562, and into a major zone of resistance, talking about 565 to 550. On these short-term timeframes, are we overbought? Not quite just yet. The 4-hour is grazing overbought conditions, have not lost these short-term timeframes, but keep in mind, guys, tomorrow is a very big day for the markets. We get the non-farm payrolls and the unemployment rate. If any of these two numbers are bad, expect the markets to embark into possible daily consolidation. And the daily higher lows are fairly close right now. Anything above 542 looking for a daily higher low for possible trend continuation, but if we engulf too much and roll this one over, that will be a new daily downtrend and the start to some weekly consolidation. As you can see, it's a very big area of resistance. These are weekly moving averages as well, and any further declines, we'd be looking for a weekly higher low. Anything above 508 would do it for a higher low for possible further trend continuation, but take back too much. If the data continues eroding into next week, you may evolve into some form of an awkward tightening range somewhere between the tariff fear lows and these most recent somewhat euphoric highs between these two resistance and support levels overall. And it's a fairly wide range for the markets, guys. You're talking like a 10% range right there for the SPY, so keep that in mind. In terms of the QQQs right now, they were up 1.31% on the day, down in the after hours because of big tech, and the analysis is largely the same. Getting rejected at the 200-day EMA. We are now above the most recent area of resistance, but I cannot close this box green until we close this weekly candle above it. Now, there is a few things in the way, such as the reports coming out tomorrow. So the higher lows are set right now at about 464. If you lose this, right, you set up a path for a daily downtrend reversal pattern, which would also be synonymous with a bit of weekly consolidation. The bulls did a great job at recapturing the weekly uptrend. You'd be looking for a weekly higher low, anything above 428, looking for a weekly higher low for possible further trend continuation. But if you take back too much of this move, maybe an expectation for the scenario would be a tightening range between these two resistance and support boxes right there. And once again, on the Qs, it's a very wide range as well, right? That's a also 10-11% range. So we'll see what happens, guys. It's a battle right now, a battle between, people just wanting the market to go up and plowing money back into tech and growth, hoping that it's going to save the market overall. But then we have several other segments of the market that are issuing warnings all across the board. Consumer defensives issuing warnings. Healthcare has not been cooperating too well as well. And banks and credit cards are holding it up, but how long can that actually last overall? So it's a push and pull in the markets right now. Still a lot of uncertainty and just a lack of overall clarity because of the tariff policies. This is currently a moving target. Recession, yes, or recession, no. Nobody knows. It depends. How much will be the final effective rate of those tariffs? How long will they be maintained? Can we get any trade deals before those impacts of those tariffs are felt, and whereby we can then remove those tariffs? These are all uncertainty factors that nobody knows. You can predict, you can project as much as you want, but at the end of the day, right, it's better to take things on a weekly basis. As I always say, guys, if you're trading, trade level to level, right? Trading level to level with a stop loss, trailing stop loss. Don't get too greedy on these massive rallies thinking that, oh, there's no more problems at all. We're just going to move all the way to back to the all-time highs. We don't necessarily have the macro conditions to do that just yet, guys. So if you're trading 1 day or 1 week timeframes max at a time, because we know the market moves very fast on these headlines. And if you have a long-term portfolio, well, it's always been so simple. Just DCA with every paycheck. Every 2 weeks, 10-15% of your earnings should be used to invest in your future self in the most high-quality companies that you can find and or high-quality ETFs. Moving on to the financial sector right now. Financials holding up good, all things considered, but the higher lows are set right now, 47.55. It is a very nice daily uptrend by financials right now, but come down and cut this low right there. You're going to be at a loss of a daily uptrend, and you open the door for the daily downtrend. Now, we are above this area of resistance, 48.34 to about 46.60, but all things considered, I will not change this box into green until we close that weekly candle above it and officially be able to call it support. In the event that the bulls lose this over the next few days, just understand what's happening here. You're in a weekly uptrend, going for a higher low. For possible further trend continuation, we will measure the size of that pullback when it does come to us. Moving on to healthcare right now. Healthcare down 2.73% after several of the biggest companies in that entire index continue being pain points. UNH, another 2.62% decline today. Eli Lilly, 10-11% to the downside. That definitely does not help. And most of all these healthcare names have just not been doing much of anything, right? Take a look at Merck, another big player in there. They're down tons. Take a look at AbbVie, one of the more resilient pharmaceutical names. They're not that far off their all-time highs, but definitely not pushing all-time highs. And even a major company like TMO has been still just beaten down, hasn't gone anywhere in the last 5 years. So healthcare has definitely been a weight and, kind of like an anchor for the overall S&P growth, because it is a big component in the S&P. Now, take a look here at the XLV index. Well, we hit a daily uptrend yesterday, and I was saying any pullback, looking for a higher low, anything above 131, looking for a higher low for possible further trend continuation. Healthcare is supposed to be defensive in the face of a recession, but it's definitely not acting that way as of late, that's for sure. In terms of the weekly timeframes, well, we tried to set a weekly uptrend, which we did. We got the higher high, but now might just be devolving back into this tightening range down there. Your 200 weekly EMA stays put at 134, and this is such a massive area of support with all of those bulls back there. The accumulation range from 2021 through 2023, 2 years of accumulation. So it's not going to be that easy to flush this sector to the downside. Moving on to SMH right now. SMH also struggling into its area of resistance, 232 down to 213. I've been saying this for a while, guys. It's a very hotly contested area, right? And now, although we have a new daily uptrend with today's candle, the higher lows are right there, 204. If we lose this, that loses the daily uptrend. It opens up the door for a daily downtrend. And at that point, you'll be looking for a weekly higher low. Weekly downtrend, high, higher low, higher high, barely. You'd be looking for a higher low. Anything above 185, looking for a higher low for possible second or third attempt at breaking through this resistance range. The idea is very clear. If we move lower in a rapid fashion, I will benefit from that volatility by selling puts under the market on my favorite semiconductor stocks. Special shout out to Micron, which is ridiculously cheap right now. Special shout out as well to companies like ASML, which have such solid business models and are still trading cheap and into support. Moving on to IWM Russell right now. They were up 0.62% on the day. Nice daily uptrend right now. The higher lows are set with the lows of yesterday, 190.5. Same concept. Moving into resistance right now, which is clear as day. 200 down to 190 is that big resistance area for the bulls right now. That being said, daily, right? If you lose this area, loss of the daily uptrend, open the door for the daily downtrend, and you also open up the door for a little bit of weekly consolidation. Nice to see the weekly bulls are in control of this time frame right now, and any pullback in a major fashion would be looking for a higher low. Anything above 181, looking for a higher low for possible further trend continuation. But if we come back too low, same concept, guys. You might just get trapped between this resistance and this area of support. Two major levels, and that's a wide range, guys. You're talking about a 12% range overall. On to the Dow Jones now. Dow Jones lastly up 0.21%. Not the worst day for the Dow Jones. Still, technically speaking, trying to reset, because here it was just a mess, right? They had the daily uptrend attempt. They lost it by flushing these lows. Now you get a nice engulfing move. But, they haven't set the higher lows into the higher highs. So we'll keep an eye on that for the Dow Jones overall. Reacting from resistance 41.3 down to 40,500 is that resistance range. The weekly chart paints a much clearer picture. Downtrend, high, higher low, higher high, weekly uptrend now in motion. But if you get beaten down over the next few days and go into a bit of weekly consolidation, anything above 37.9 or 40K roughly, let's call it, is going to be looking for a weekly higher low for possible second attempt at this resistance range. But pull back too much and you open up the door for maybe a tightening range between this big area of support and this big area of resistance, which also is a very wide range, guys. It's a 7-8% range for the Dow Jones. And that is pretty much it for your index analysis. Onto the VIX right now, down 0.32%. The VIX still being sticky right now in the mid 20% range. Trust me, if we get more negative macro uncertainty events, such as the catalyst from non-farm payrolls tomorrow, well, that'll definitely make the VIX spike. You can see that whenever we do get some negative catalysts on a day, the VIX can spike 5, 10, 15%. We are still being sticky, as we've seen many times before in times of economic uncertainty. The VIX can stay sticky longer than you might expect. This was 2022. This was the COVID pandemic. This was 2018 tariff episode number 1. This is 2016 election uncertainty. This was the 2011 flash crash, and this was the great financial crisis. So in times of heightened macro uncertainty, the VIX can stay high for longer, right? And that's a great opportunity for us as option sellers to sell credit far away from the current market price and just pocket that very juicy volatility premium. Onto the dollar and the yields right now. So the dollar performing nice. It's back into a nice daily uptrend, right? Trying to get back some of this weekly momentum that it's since lost. But I mean, guys, that's a 2-year support range, which was broken to the downside. And logically speaking, you'd be testing it as resistance. Are we going to do something like this? I don't know. That's why I have a question mark right there. It all depends on foreign investment into dollars. If the macro conditions get more clear and we have more trade deals, then maybe, just maybe, we can recapture this entire area. If it gets more murky and more cloudy and the deals are not so good, right, and people stay somewhat skittish towards the US dollar, that's when you might experience the rollover overall. That is also why your yields have been very sticky here. The 10-year yield has been sticky around 4.2% for the last few days as the market tries to price in the impact of the tariffs on the US dollar, on speculation of whether or not people are going to start dumping US treasuries or not. Is the Federal Reserve going to buy US treasuries with a quantitative easing program through the treasury? I don't know. Nobody knows. That's why yields are so uncertain right now, right? They're very tough to derive a trend. 20-year yields also staying very sticky around the 4.73%. All we know is that there is some form of a Fed or Trump put. When the 20 hits 5 and the 10 hits 4.5, you know that either the Fed or Trump is out there trying their best to kind of ease the market with the statements that they make, which means TLT is still a very decent trade overall from the lows, but one that you have to be very patient with if you are looking for that expansion. That's everything for dollar yields and otherwise. Moving into gold right now, gold breaking down, daily downtrend. I was saying pay attention to this tightening range on gold here. You will have your answer when it breaks either way. Break to the upside and the next area of take profit is up here, but break to the downside and you end up with the downtrend, right? Which is why I don't like playing ranges, guys, right? I don't like playing ranges. The way that you play ranges is breakout, retest, and run. That's a trade entry, or breakout, retest, and run. Here we haven't quite got it yet. You'd have to look at the 4-hour time frame. If you maybe backtest this, maybe that's an entry for a follow-through short on gold overall. It's been fairly weak, right? Because the markets have been pumping. But the weekly time frame paints the clearest picture. I've mentioned this a few times after last week's candle close. Nice weekly uptrend, but eventually it has to pull back. And where does it always pull back into? The 12 EMA. At least it has so many times throughout its history after these historic periods of rally. The 12 is like a magnet. So maybe the magnet is reattracting it to the 12. And at that current stage, it is $3,100. So pay attention to that. Bitcoin having a very nice day today, finally breaking out of the barcoding range overall. So now these elements are your daily higher lows, with the higher highs being set. So the daily option still continues on Bitcoin at this point. Higher lows is anything above 92.5, let's call it, looking for a daily higher low for further trend continuation. That is if they don't just blast off right away. If they do, you guys know where the next area of profit is. It's 100 roughly to about 105. That being said, nice new weekly uptrend, and the monthly continuation stays strong, looking to proceed into monthly expansion as well. If the markets remain in somewhat of a bullish environment as we've seen, maybe Bitcoin has a week, 2 weeks, 3 weeks of extra rally into it. But if the macro really starts degrading, guys, Bitcoin is probably going to get dragged down in the mix, because at the end of the day, it is still viewed somewhat as a risk-on asset for the most part, yeah? That's pretty much it for your sector and market rundown. Now let's dive into some big tech names. So moving on in first to Apple. So Apple was up 0.39 on the day, but down 4% in the after hours at 204. So right about there. Where does Apple currently stand in terms of the daily? Well, Apple is right now in the midst of a daily uptrend, looking very good with the higher highs, but now getting rejected at resistance, 221 to 211. I was talking about this area, a lot, guys. That was the take profit zone. If you had some swing trade orders into this area, that's exactly where I closed them myself. And now pretty much the trades are pretty much dead at this current time. That being said, anything above 189 is still looking for a daily higher low for possible further trend expansion, but pull back too much. And as I said, you open up the door for the daily downtrend, and you also open up the door to the weekly consolidation phase. It is, technically speaking, well, they won't close this week up there unless they recover 4% by tomorrow, but it was a nice weekly uptrend attempt. Pull back too much, you might end up in some form of a tightening range. Next support stays planted, 196 down to 187. Swing trades for me now at this current stage remain down at those lows. If Apple keeps dropping, I will gladly sell some put options under those fear lows, and any swing trades like with call debit spreads or shares should be considered in that location when you get more favorable price action. On to AMD right now. So AMD down 0.72% today, and more a bit in the after hours overall. AMD had a nice daily uptrend underway, but I was also, telling you guys to be a little bit cautious because this is a big resistance zone. 112 down to about $98 is that big resistance area. And after so many green days in a row on the indexes, well, it raises the question, can it really push hard into there before its own earnings? I don't know, but they have earnings next Tuesday after the bell. That is going to be the biggest catalyst for AMD overall. Lose this daily higher low, you lose the daily uptrend, but with only a few days of trading left, who knows what's going to happen? AMD usually has an expected move of earnings of 10%. 10% from here to the downside puts you right back at the fear lows. 10% to the upside might clear a good portion of this resistance range and could put the stock into a weekly uptrend overall. Very curious to see what happens with their earnings. I'll be waiting to see, but if AMD comes down here before or after their earnings, maybe I take it upon myself to write some short puts in the lower $80 or high $70 range if I can find some good volatility premium. Moving on to Amazon right now. Amazon just had their earnings as well, down about 3% in the after hours, right about there. So Amazon tried to go for the daily uptrend attempt, could not break that level of resistance, 191 to 180. We're still trapped into it right now. If you lose 179, you are losing the daily uptrend attempt. You open up the door for the daily downtrend, and you open up the door for weekly consolidation. It was a nice weekly uptrend attempt by the bulls. Any further consolidation to the downside, looking for a higher low, anything above 166, looking for a higher low for possible further trend continuation. Possible further trend continuation, right? We don't know. That being said, trade entries for me would have to definitely be down there. And if it does move down, I'll be doing two things. Maybe some short puts below there, and maybe some call debit spreads or some swing trades if I can find some favorable price action. We'll cover it one day at a time. I'll let you guys know if there is a swing trade setup when we pull down into that region. But for now, nothing yet for me. I'll let it consolidate a little bit. Google up 1.18% today, even up a tiny little bit in the after hours. Overall, Google is still in a very healthy daily uptrend. Higher lows are now set, right, at the 157.34. But if you lose this without setting a new high, that would be a daily downtrend. So pay special attention to the markets tomorrow. Daily downtrend is synonymous with this resistance area getting rejected on Google again into the moving averages. You'd be looking for a higher low, anything above 150, looking for a weekly higher low for possible second or third attempt at breaking through this resistance range. Pull back too much, though, you might just end up in some form of a very awkward tightening range, which is great when you're looking for the lows to sell puts down below there. I'll let you guys know if there's any swing trades that I see on Google right now, but for now, I'll wait to see what the stock can do. Breakout and retest, that'll be a nice trade, or just come back down into there, and there might be a trade. Right now, trading it into resistance is a little bit tricky considering how much the indexes have ran in such a short amount of time. Onto Meta, 4.23% was the after earnings effect. However, they did close around the low of the day. They popped up really nice, guys, from the pre-market, but from the pre-market all the way down to the lows of the day, you're talking about a almost 5% sell-off overall. That being said, Meta has created a lot of space. Yeah, this is a clear daily uptrend by the bulls into resistance. Could not clear that 600 psychological all the way down to 558, the bottom end of that resistance. Anything above 530, looking for a daily higher low for possible further trend continuation and break through that resistance range. Can they get it done? I don't know, but there is still a gap down below here, so be mindful of that. Any daily downtrend loss or just, extra consolidation here on a daily downtrend would be synonymous with just weekly consolidation as well. Bit of a tricky one, Meta, because you did not really confirm a weekly uptrend. These are double tops right there. If Meta moves lower, no problem at all. Big support below us, 530 down to 450, and I would love to buy some more Meta shares if you can give me the opportunity in around the fear lows overall. Fantastic company. We covered their earnings yesterday, and they have been resilient in the face of macro uncertainty, but no company is immune to overall recession fears, as we have clearly seen from this sell-off down there. Moving on to Microsoft now, maintaining good gains, but also closing at the low of the day. I was also telling you guys, right, when you get a big earnings pop like yesterday, hourly overbought conditions, right? 4-hour overbought conditions. It's very tricky, especially into resistance. Resistance highs, 435 down to roughly 425, this $10 range. It's been problematic a bunch of times for Microsoft in the past year's worth of time. So we had to pay attention and know where we were in the chart. Yeah. So moving on in, daily uptrend is now clear of day. There's a big gap below us on Microsoft. They had fantastic earnings. I would not be surprised if the market consolidates. Microsoft is going to consolidate as well. Yeah. If I can find it somehow back down 410, 405, that would be a nice breakout, maybe retest area of this zone, which tomorrow, provided the candle closes green, which I'm pretty sure it will, but who knows? Tomorrow, this will be our new support zone. Weekly uptrend. Yeah, if we backtest 405 to 400, that'll be a very nice breakout retest and maybe rally. There is a swing trade there for sure. Not up here, but a swing trade down there, yes. And if it comes down a little bit hard, I'm going to be looking to sell some put options down there, sub 400, think 380s. Moving on to Netflix right now. Netflix, still another green day for Netflix. Daily overbought conditions remain. No loss of the 4-hour uptrend. This is just such a clean-cut chart, but the moves are getting smaller and smaller and smaller and smaller and smaller. The bulls might be running out of gas, guys. These moves don't last forever. If you do pull back, though, tons of space. Anything above 901, looking for a higher low for possible further trend continuation. But if the overall market goes into a downtrend, Netflix might follow. Daily downtrend, that would just mean a weekly consolidation phase for the stock. Anything above 825, looking for a weekly higher low for possible weekly further uptrend after a bit of a consolidation phase, kind of like gold. It's well off its 12 EMA, guys, well off. And every time Netflix does this, people never think it can come back, but it always comes back and touches the 12. It always comes back and touches the 12. So just be patient and you may find an opportunity that you might be excited for in around the $1,000 mark, which is currently the 12 EMA for the stock, or it can just stay sideways and wait for the 12 EMA to catch up, right? Who knows? But buying it right now, a bit of FOMO in my opinion. Moving on now to NVIDIA. So NVIDIA up 2.47%. Not a bad day for NVIDIA after that renewed CapEx bullishness on spend from Meta and Microsoft, but additionally, closing at the low end of the day. Daily uptrend is clear right now, but not able to breach resistance. 115 down to 104. So we're looking for a higher low. Anything above 104, looking for a higher low for possible further trend continuation and breach of this big resistance range, which is fairly big, guys. I mean, it's all those guys from there, all these guys from there, and then it's been resistance now for the past, what, 3-4 weeks overall? It is a very big level. If you lose this and go into daily downtrend, well, unfortunately, guys, no new weekly uptrend has been set. They try to go for it, not getting it quite yet. Any consolidation will just be a tightening up again of this wide range, guys, between this resistance box and support. I would love to find NVIDIA back down, you know, sub $100. I'd buy a couple more shares, but also it opens up the door for selling puts, you know, in the lower 90s to high 80s, which is the next big support area for NVIDIA. NVIDIA, fantastic earnings. They only have earnings, fantastic company. They only have earnings coming up at the end of the month of May, but in around $100, the company still objectively still is cheap. Moving on to Tesla right now. Tesla down about 0.58% overall. So not that bad of a day in terms of price action for Tesla, but we know no new highs have been set into motion. Now, daily 200 EMA is here at 287. We've been struggling with that. But the top end of resistance, 300 psychological, down roughly 260. It's a very hotly contested area, guys, right? Big resistance, big resistance, big resistance. Top end of these guys, resistance, support back here, and resistance from 2021. A very big area for Tesla, and you're battling all of the weekly moving averages as well. I know the MACD momentum indicator looks good, but still no cross and no indication that the bulls are permanently back, yeah? Have not really set a new weekly uptrend either. We tried to go for it, but still to no avail. If we drop a little bit and we lose somehow this daily uptrend into a downtrend with the rest of the markets, you know that we're just going to get stuck in a big range, right? This range of support down to 220 to 200. Very wide range for Tesla right now. You're talking to like a 25% range. It's the same. You look at the SPY, the QQQs, other big tech names, it's the same, right? They're all coming into resistance. And, right, if we lose it, we have big support below, but we know they're very wide ranges. And with so much volatility and headline risk, I would not be surprised if this push and pull action in the markets simply continues. On to Palantir right now, down 1.89%, but they did hit a new high of the day. They hit 120 before retracing a little bit. Palantir, very beautiful daily uptrend right now. Any move lower, anything above 88, looking for a higher low for possible further trend continuation. That is if they don't do it right away. We'll keep an eye on it. It is seeming to curl on the RSI. The time frames as well, we did have an hourly downtrend being set with a loss of the moving averages. We know Palantir sometimes can pop back above. They have one more chance, but one thing's for sure, guys, if you lose the 4 hour into tomorrow, well then for sure you're into daily consolidation and you can expect some further moves to the downside. That being said, Palantir has earnings on Monday. We'll get to hear from them. So only 2 trading days remaining for Palantir. Very tough for me to know where the stock's going to end up before their earnings, guys, because it's not going to matter, right? The earnings expected move is 10%. 10% from here, you know, we'll send you right back down to 105. 10% to the upside and you're at new all-time highs. So, you know, very tough to derive price action, but the chart so far is looking good. The bulls have created a ton of space here on the weekly as well. If there's any big form pullback on Palantir, it's just for higher low. Anything above 67, guys, looking for a higher low. The biggest area of support, of course, is down there, 96 to about $90. Moving on to SOFI now. SOFI continues to be struggling after their earnings, right? Poor SOFI. They just cannot keep it up. We are keeping ahead of the moving averages, though. It is still a nice daily uptrend. Still searching for those daily higher lows. We'll see where they are set. Anything above 1040, looking for a daily higher low. For further, maybe trend continuation. If they can't get it done and set the lower high into lower lows, you guys need to understand they're doing the same thing as the rest of the market. Beautiful weekly uptrend into resistance 14 to 16, and now might be looking for a consolidation phase. Anything above 1047, looking for a higher low for possible second attempt at that resistance range. Or maybe, just maybe, SOFI just gets trapped for an extended period of time between these two levels. I don't know, anybody's guess. One thing's for sure though, if we do come back down there, that's where I start writing some short puts on this stock and start looking for some swing trade longs. Moving on to Uber. Uber cracking through the highs, guys, cracking almost $82, looking very good, cracking through the resistance range as well. $80 down to roughly 77.5 is that range right there. If we're taking a look here for the daily option is very, very, very nice on Uber. Higher lows are set with the lows of yesterday. Higher highs, now anything above 77.16 is looking for a higher low. Maybe, just maybe, they can use this as a backtest location for further trend increases. But if the whole market pulls back, do you think Uber's going to do that? Probably not. So the context of the market matters a lot. One thing's for sure, though, the weekly is looking good. Weekly downtrend, nice engulfing move. Now, any extended pullback on those time frames, looking for a higher low. Anything above 61, looking for a higher low for possible further trend continuation. I would like to see Uber come back down here on market consolidation or correction. I'd write some short puts under there and might be due for some swing trade longs as well. They've held up beautifully, and the monthly candle close was really good. So back test on the monthly, little doji candle, maybe for some expansion. We will see. We get to hear from their earnings next week as well on Wednesday. Moving on to TSM now, 3.62% to the upside is TSM, looking not too bad. Daily uptrend is still firm for this stock. Higher lows are now set at 161. So any move lower right now, looking for a higher low. Anything above there, looking for a higher low. Maybe for trend continuation, getting rejected at the 200 EMA right now. But if they do close in around there, I will be able to close this big resistance range into green, right? This is the big area of congestion from those monthly candle closes overall. Nice monthly candle close for the month of April. And now maybe for some expansion into May, I don't know, but we'll take it one time frame at a time. If we lose the daily uptrend back down into there, you're looking for a weekly higher low. This is a very clear weekly uptrend right now, looking for a higher low, anything above 146, looking for a higher low for further trend continuation. If we drop, I'll be looking to sell some puts under the lows of here into support, which stays planted 146 to 139. I would also be looking for maybe some swing trade longs if we dip back into the mid 150s on some short-term oversold conditions. So that's everything I had for you guys for our markets today. Hopefully you guys enjoyed. If you did, consider dropping a like, would appreciate it for the growth of the channel. Also consider subscribing if you're new. We do these videos every Monday to Friday after the close, so hope to see you back in the future. Lastly, if you have any questions, always feel free to leave them down below. Questions on stocks, options, macro, anything you want. Always love reading and responding to your comments, guys. So please definitely leave them down below. I will answer them tonight. And if you are considering joining a trading community, well, maybe you would consider joining ours. You get access to all of my trades in real time, not only these wheel trades, but every single type of setup that I possibly take on a week-to-week basis in the markets, right? There's wheel trades, which is basically selling puts into the market, call debit spreads, credit spreads when they're there, debit spreads, call debit spreads, do a lot of those, share swing trades, leap call swing trades as well, and long-term portfolio building as well. A very important portion of our Discord. Get many questions on that. You also get access to our private morning live streams every Monday through Friday at the open, where I trade live for about 2-3 hours and answer all your questions on your stocks, your options, and your long-term portfolios. And additionally, guys, if you cannot be in the live streams, they are recorded, so feel free to watch them afterwards. And you can also ask me all your questions in real time in all of our chat rooms, and I'm very fast to answer from 9 in the morning all the way through 9 at night, so feel free to use those chat rooms as well. We also do private videos, advanced level strategies that I don't show so much on YouTube, a whole bunch of option strategies, technical analysis, how to grow portfolios, small, medium, large, which strategy and which proportion of the strategy should you be running in those portfolios depending on the size, and many other videos, guys, that people have been finding tremendous value in. And you also get access to all of my watch lists, all the options watch lists, the wheel watch lists, everything like that. You copy paste, you get all of them for free. And additionally, guys, as well, well, it's included in the package, of course. Yeah, you get access to all my technical analysis as well. Whenever you see support, resistance, trend lines, anything I do on the charts, copy paste all my chart setups. Additionally, too, very easy to do, 2 clicks of a button, and you get access to all the annotations that are ever on the charts for probably 200 stocks right now when I go through earnings, or when I just do fundamentals in the live streams on a whole other bunch of stocks that I don't really talk about that often in these videos. You get access to all that. If you're interested, the link to the Discord is down below in the video description. Hopefully I see you guys in there soon, and if not, I guess I will see you back on the channel. That's it for me, guys. Take care. I will see you tomorrow after the close, where we recap non-farm payrolls and when we recap those 4 company earnings that I did not have time to talk about this week, which will be Spotify, Booking Holdings, SPGI, and then probably MasterCard. So take care, guys. Always a pleasure. That's it for me. Peace.